My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to save you some money. My job is to entertain, but really to explain, okay? So call me at 1-800-743-CBC or tweet me at Jim Cramer. I get it. Nobody ever wants to give up their gains. You don't want to watch Meta Platforms do a U-turn and surrender everything it made after that magnificent quarter. Sell, sell, sell. You don't want to see Walmart soar and then repeal the whole move after an amazing quarter, no less. It is agonizing to witness AMD give up a quick 25 points when their future seems so bright. But sometimes you have no choice, and I think this is actually one of those times. We just had another bad day. Dow lost 291 points. S&P shed 0.77%. NASDAQ tumbled 1.17%. Boy, did it get ugly at the close. What do you do at moments like this? Rather than trying to trade in and out, selling everything and then trying to buy it all back at lower levels, I think you need to learn how to ride out these moments. Unless stocks aren't for you. See, I think if you're patient, I believe you'll do better sticking with stocks rather than hiding out in treasuries, even now that they even have much more generous yields than they did a year ago. So let's start with a key word here, and that word is patience. Now, 2 weeks ago, we had the eminent market historian and technician Larry Williams in studio for Chart Week. And he made it very clear that August would be a tough month. It was a pretty good call. He didn't even want to sound the all clear in September because he thinks the first 12 days will also be tough. After that, though, he says the bull market should resume. Larry said patience was warranted. He called it the P word because this sell-off will likely end. So you have to sit on your hands while stocks retreat. Sure, you can get out. Go put your money in the 10-year where you get 4.3% risk-free. But I think you can do much better by sticking with stocks for the long term. Does patience make sense for everything? Of course not. But as I told members of the CNBC Investing Club at our monthly session today, if you like your stocks and you like the fundamentals and they're not hurt by a rapid rate increase, that does matter, by the way, you should be thinking about buying them into this dip when the market gets really oversold, not selling them. Second reason to stick with the market, I'm going to introduce a concept that's a little bit ethereal. The concept of rain. Hey, we accept that there are always going to be rainy days, don't we? Market has weather, too. Sell-offs are rainy days. They're no fun, but they're also necessary for stocks to go higher long-term because they shake out the weak hands. They allow the stocks to grow. So I'm urging you to accept the pullback the same way you would accept the weather. Stop looking at your positions every day. If it helps, do that. Silly? Hey, I'll use any analogy if it helps, and not just because I have been a gardener for 3 decades. Next, not that long ago, I took a look at a video of the flash crash back in 2010, where I came on our air and said the sudden 1,000-point decline for the Dow was just the stock market breaking down, not anything fundamental, and the market was breaking down because it could have handled the orders. I was right. The market broke for a moment, and it turned out to be an amazing buying opportunity. As I looked over the video from 2010, though, I found myself mesmerized by entirely something else, by what's known as the ticker underneath the picture. You can see that. The ticker, which holds the price of stocks. As those stocks passed, I noticed there were dramatic gains that most stocks have made since that happened in 2010. Oh, there were losers that were trading too. They were very few and far between. Even Intel, the relatively pathetic semiconductor stock, is up since 2010. But I was more caught up in watching block after block of a company called Intuit, the small business service software company. It was really incredible. It just kept... Right, it just kept coming by. Intuit now trades at 486, but, well, it was in the 40s when I saw it. Yeah, in the 40s. Now, in the interim, from when it was in the 40s, what did I see? I saw a swoon from 107 to 79 in August of 2015, buy. There was a decline from 231 to 182 at the end of 2018, buy, and a 306 to 187 beatdown when COVID hit in 2020. Buy. Intuit's experiencing a dive right now, too, selling off from 716 to just under 340 at its lows before turning around to 486 right now. I know Intuit had a hiccup in one of its earnings lines to justify somewhat of a sell-off here, and it just lost one of its best people, Alex Chris, who headed up the Small Business and Self-Employed Group. He's now taking over as the new CEO of PayPal. But Intuit's doing so well that I'd rather think forward than backward. I bet it's a buyable blip just like the others. Can you imagine owning this phenomenal long-term winner, then getting spooked out at selling it at 100 or 200 or 300 or 400 each time just to avoid the short-term pain in the house of pain?
The house of pain.
In a stay in the house of pain? No, it's only natural to want to avoid pain. Each time you could have held out in bonds rather than sticking around into it, although the yields were much worse back then. But you can see how little you really make in bonds versus some random high-quality growth stock that happened to have its ticker symbol come by during the clip I saw. This thing's going from 35 to 486, for heaven's sake. You would have been better off riding out the downturns rather than trying to get cute swapping in and out. Still, the dispiriting nature of a day like today, which opens fine and then cascades, it's not lost on me or you. I watched the market begin to pirouette down hard while Jeff Marks and I were running the monthly noon investing club meeting. I had to fight the urge to say, look, this thing's going down today, so you better get out and maybe come back at better prices. I could intuit, so to speak, that today would have some heartbreak, in part because of the viciousness of a couple of stocks. The viciousness with the stock of drugstore and healthcare company CVS was manhandled when its pharmacy benefit manager subsidiary Caremark lost a big Blue Shield contract to Amazon and a healthcare cost containment company run by Mark Cuban. CVS reaffirmed its earnings forecast midday, but that was a little comfort. Now, I also saw how Walmart stock got absolutely clobbered on were really excellent earnings. It was obvious to me that these were terrible omens for the day. Sell, buy, sell, buy. Of course, I wanted to say just get back in at a lower level. But I know better. That's very, very hard to do. Think of it like this. I can't tell you what's going to happen to CVS. I don't like that stock. I haven't for a long time. And that's because I get the creeps when I go there because I need to call for help every time I want to get any name brand product from out of a blind lock and key. I used to stop by during work to pick up what I needed for home. But now I just order from Amazon before I leave my home, and there it is, faster, less aggravating when I get home. CVS now is a horrendous business model compared to Amazon. But how about the Walmart? All right, I figure the analysts will rally behind it and raise the price targets tomorrow because that's pretty much what they always do. But let's go back to that Intuit situation. Do you think I can even recall what happened that caused each of those vicious swoons over the past 13 years? Did something go wrong at the company? Did interest rates jump up as they did today? Did some rival product come and go? I have no idea. All I know is that there were plenty of days like today during the last 13 years, and each one of them could have been a great moment to sell into it, but only if you were able to get back in at a lower level. Unfortunately, again, I think the vast majority of you couldn't do it. I know I couldn't. Bottom line, I don't want you sacrificing huge potential gains like Intuit on the altar of perceived safety, because when you look back, trying to sidestep these relatively small declines tends to give you worse returns than simply staying the course and riding out that rainstorm. Let's go to Peter in New York. Peter.
Hi, Jim. How you doing? A big booyah from New York.
Thank you, Peter. What's going on?
We're big fans of yours.
Thank you.
Now that everyone is traveling again, why is Airbnb continuing to go down?
Well, that's because, Peter, I'll tell you why. Because people aren't smart. This is a stock that had repeated breakdowns. And I've been recommending the stock after every single breakdown because Brian Chesky, the CEO, it is a great operator, and they have a great app, and I am with you, Peter. I think that when we get really oversold, Airbnb is a buy. David in California. David.
Hey, Mr. Cramer. I've been watching your show for 2 decades, and I just retired from Cal Poly. I have a question for you.
Yes.
I own 2 stocks in my IRA account that I would call safe stocks with pricing power, pay decent dividends. They sell similar products, similar PE ratios. However, one has better earnings, higher margins, and less debt, but the other is about to split into 2 companies. So I'm wondering what you think. The companies are Kellogg and General Mills.
All right, I think that General Mills is an amazing company, and they've done a lot of stuff to be able to diversify away from pure food, including buying Blue Buff, which was a brilliant move, and I say that as a dog owner. Kellogg, I think we got to see how those different pieces work. Let's give that one some time. Let's stick with General Mills, and thank you for Camp Hollywood. That was great. Let's go to Doug in Tennessee. Doug.
Hey, Jim. How you doing?
I am doing well, Doug. What's happening?
Not a lot, my friend. Love what you do. Love what you do.
Thank you, Doug.
My question, Jim, is about the sustainability and profitability of Carvana stock moving forward. Last quarter, they posted a 40% higher per car sold profit. and still we're in the red.
Well, I got to tell you something, Doug. I think you're right to be find the situation problematic. Right now, there's a really good article in Automotive News saying that the car dealers have way too much inventory, and that is very, very worrisome to me. And it's been a great way. You made a lot of money in Carvana. I think it's time to ka-ching, ka-ching, ka-ching. All right now might feel like one of those times where it would be just so great to get out of the market, avoid the losses, but maybe staying patient here will pay off down the road. On Mad Tonight, as we just discussed, today's tape was miserable, and I see rates going higher. I'm not blind to this stuff. So should investors turn to a company like Realty Income, which also goes by the monthly dividend company, to ride out the turbulence? I'm seeing if this could be the stock for you. Talking to the CEO, of course. Then earlier we held our monthly meeting for subscribers to the CNBC Investing Club. We had too many incredibly great questions sent in by club members that we decided to answer some of them tonight. And you will not want to miss my interview with a company I've tried to have on for 18 years. And that's Cintas. Yes, it's got the finger on the pulse of two important sectors, small and medium-sized business in the service industry, the backbone of our nation. And I'm checking in on the state of both of them with the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.